Welcome back to the Ultimate Trading Podcast for beginner traders. This is your go-to spot for learning how to make informed, strategic decisions in the world of trading. Today, we're diving deep into tip 26, interest rates, and how they can make or break your trading strategy. This topic is absolutely essential if you're serious about understanding market trends and making the right moves at the right time. So, let's start with the basics, interest rates. Now, I know the term might sound a bit dry, but trust me, this is one of the most important factors that can influence your trades. Interest rates are, in essence, the cost of borrowing money. When a central bank raises or lowers these rates, it's like flipping a switch that influences a whole range of economic activities. Paul Krugman, the well-known economist, once said, "Interest rates are a vital tool for managing the economy." And that's exactly how it plays out in the markets. Central banks, like the Federal Reserve in the US, the European Central Bank, or the Bank of England, control these rates. By adjusting them, they're trying to steer the economy in a certain direction. Lower interest rates typically encourage borrowing and investing, while higher rates do the opposite. They make borrowing more expensive, which can cool down an economy that's getting too hot. But how does this impact us as traders? Well, interest rates influence pretty much everything in the financial markets. Whether you're trading currencies, stocks, or bonds, interest rates have a direct or indirect effect on what's happening in the market. So, staying on top of interest rate decisions is a key to making better, more informed trades. Let's break this down further. First off, the relationship between interest rates and economic activity is huge. When interest rates are low, borrowing becomes cheaper, and that encourages both businesses and consumers to spend and invest more. Think about it, if you can borrow money at a low cost, it's easier to finance a new project or buy a home. This, in turn, boosts economic growth. On the flip side, when central banks raise rates, borrowing becomes more expensive, and the flow of money slows down, which can reduce economic activity and, ultimately, control inflation. Speaking of inflation, interest rates are one of the primary tools central banks use to manage inflation. Milton Friedman, another famous economist, said, "Inflation is always and everywhere a monetary phenomenon, and the way central banks control inflation is by adjusting interest rates." If the economy is overheating and inflation is rising, central banks may hike interest rates to slow things down. On the other hand, if inflation is low and the economy needs a boost, they'll lower rates to spur spending and investment. Now, let's talk about currency values. This is an area where interest rates really show their power. You see, when a country's interest rates go up, its currency tends to appreciate. Why? Because higher rates offer investors a better return on their investments in that currency. It's simple, if you can get a better return in one currency than another, you're going to want to invest in the higher yielding one. So, if the Federal Reserve raises interest rates, the US dollar typically strengthens, because more people are going to want to hold US assets, and that drives up demand for the dollar. But it's not just about currencies, interest rates also have a direct impact on bonds. There's this well-known inverse relationship between interest rates and bond prices. When rates go up, existing bonds with lower yields become less attractive, which causes their prices to fall. But if interest rates drop, those older bonds with higher yields become more appealing, and their prices rise. And of course, let's not forget about the stock market. Lower interest rates can be great news for stocks. When borrowing is cheaper, companies can take out loans to finance growth, expansion, and innovation. That's usually a good thing for stock prices. But when rates rise, borrowing becomes more expensive, and that can hurt company profits, which leads to lower stock prices. Jim Cramer, the well-known market expert, says, when rates rise, stocks have to compete with bonds for investor money. So, if you're watching the rates, you're in a better position to predict how the stock market will respond. Okay, so now that we've got the theory out of the way, let's take a look at a real-life example of how interest rate changes can impact the market. Let's rewind to 2015. After the 2008 financial crisis, the Federal Reserve kept interest rates near zero for years, trying to stimulate the economy. But by 2015, the economy was showing signs of recovery, job growth was consistent, inflation was rising, and things were looking up. So, the Fed began raising interest rates gradually. As you can imagine, this had a major impact on the market. First, the currency markets reacted quickly. The US dollar strengthened as investors moved their money into dollar-denominated assets, attracted by higher returns. The USD index, which tracks the dollar against a basket of other currencies, started to climb. Traders who had anticipated this move and positioned themselves to go long on the dollar saw significant profits. But it wasn't just about currencies. Bond markets also felt the impact. As the Fed raised rates, bond prices started to fall. When rates rise, new bonds offer higher yields, which makes older bonds with lower yields less appealing. Those who saw this coming, and adjusted their portfolios accordingly, by selling off long-duration bonds or buying shorter-duration ones, avoided losses. And then there's the stock market. Initially, the stock market liked the idea of the Fed raising rates. It saw it as a sign of economic strength. But as rates continued to rise, the stock market started to get nervous about the potential for higher borrowing costs, which could hurt corporate profits. The S&P 500 saw some serious volatility during this period, and traders who were paying attention to interest rates had to be nimble in adjusting their positions. The big lesson from this case study is that interest rate decisions are a major signal for traders. If you can stay on top of what the central banks are doing and understand how their actions will affect currencies, bonds, and stocks, you'll be in a much stronger position to predict market movements. But there's more to it than just reacting to rate changes. Understanding the economic indicators that influence these decisions is just as important. If you can anticipate what central banks will do before they do it, you'll have an edge over other traders. Watching things like employment numbers, inflation data, and GDP growth can give you clues about whether rates are likely to go up or down. Now, here's a question for you. Have you ever made a trade based on interest rate decisions? How did it work out for you? Drop your thoughts in the comments down below, and let's discuss how watching interest rates has impacted your own trading decisions. In conclusion, interest rates are an incredibly powerful tool that central banks use to manage the economy, and they have a profound impact on all financial markets. By understanding how interest rate changes affect currencies, bonds, stocks, and overall economic activity, you can make smarter, more informed trades. Keep an eye on central bank policies, monitor those interest rate decisions, and use them to predict market trends and manage risk. I hope this episode gave you some clarity on how interest rates work and how to incorporate them into your trading strategy. Keep learning, stay informed, and as always, happy trading!
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!